What if I told you that you could pay off your home in just 5 to 7 years without changing anything in your income or your lifestyle? Not only could you save hundreds of thousands of dollars in interest, but you'll also be setting yourself up for a retirement income. Sounds too good to be true, I know. Stick with me here and I'll show you exactly how the strategy works. My name is Cody Graham and I help families secure home loans locally here in Las Vegas. My brother and I are lucky enough to work with my father, who's been doing this for over 30 years. One of the most exciting programs we've worked with has been around for about 5 years now, and it's already helped hundreds of people across the country become completely debt-free. In this video, we'll break down how this mortgage-free life program works, who it's best for, because it's definitely not for everybody, and the incredible benefits it has to offer, like paying off your home in just 5 to 7 years, saving a fortune in interest, and even creating a retirement income. Now let's dive in. Before explaining how the program works, I want to go over what is required to qualify for this type of loan. Not everyone will qualify for this program. If you cannot handle your finances in a disciplined manner, we will not recommend this program for you. Here are the 4 main requirements. Number 1, you must have a 30 to 40% income gap between your net income and your total expenses. Unlike a regular home loan, which uses gross income, this program considers your net income and all your expenses, not just what is on your credit report. This key component determines if the program will work for you. Number 2, you must have at least 15% equity in your home. Number 3, you must have a 680 or above credit score. And number 4, you need financial responsibility and discipline. In this section of the video, we will go over how the program works. It's important to go back to the basics and take a look at how an ordinary 30-year fixed amortized loan works. Before you skip ahead though, it's important to visit this point in order to understand the first part of the strategy. We all know that the regular 30-year fixed mortgages front load the interest payments in the beginning part of the mortgage, which in turn lowers your principal balance by a very little amount in the very beginning. You really only gain equity in the latter part of your mortgage. Let's look at an example of something we might see today if you were closing on a new home purchase or a refinance. A $400,000 loan with an interest rate of 7% would give you a regular monthly payment of $2,661.21. This is obtained using a formula that they created a long time ago. This is just a calculation that was made to amortize or pay off your loan over the desired term, usually 30 years. More importantly, let's go over how the principal and interest portions of this payment are calculated. Your loan balance, $400,000, multiplied by your interest rate, 7%, divided by 12 months in the year. Your very first interest payment in month 1 of your mortgage would be $2,333.33. Subtracting this from your regular monthly payment would put your principal at reduction at month 1 of $327.88. Congratulations, your mortgage balance is now $399,672.12. I know this is boring, but stick with me here. I want you to see what this looks like month over month. Month 2 would look like this. Your loan balance of $399,672.12 multiplied by 7% interest rate divided by 12. This would give you an interest payment of $2,331.42 and a principal payment of $329.79. Congratulations again. Your month over month difference going to principal is $1.91. I'm sure you'll pay this off very quickly. With this foundation laid, I want to now explain the first and second part of the mortgage-free life, the sweep account paired with a home equity line of credit. This first and second leg of the stool involves trading your traditional 30-year fixed amortized loan for a home equity line of credit. More specifically, one that's paired with the sweep account. You're probably asking yourself, what the heck is a sweep account? A sweep account is an ordinary checking account that connects directly with the home equity line of credit. I think it is best explained with an example, showing the utility of the sweep account and its purpose. Our borrower, John Doe, has a $400,000 loan, same as he did before, that he has now traded for a HELOC that is connected with his sweep account. He has a new interest rate of 8%. Yes, this is higher than your regular 30-year fixed loan, and it sounds counterintuitive, but stick with me. John also has a $10,000 a month net income, not gross, but only $5,000 a month in expenses. For simplicity's sake, let's say John gets paid on the first of every month and gets paid $10,000 directly into his checking account. Normally, this money would be sitting in his checking account just collecting dust until a bill comes due. Let's put this $10,000 to good use for John. This is where the sweep account comes in. John gets direct deposited the $10,000 into his account on the first of every month. That very night, the sweep account automatically sweeps over these funds into his HELOC. This will in turn bring down the balance of John's HELOC to $390,000. His checking account will then show a balance of $0. This may seem scary, but the sweep account also works in reverse. Whenever John pays a bill, buys groceries, or pays anything, you can simply charge this to your checking account, and whatever funds are needed to cover these expenses will be sent from the HELOC to the checking account at midnight. Because the nature of a HELOC is that the funds are accessible and revolving, almost like a credit card. Now, why in the world would we need to send John's $10,000 to the HELOC in the first place? This is a huge piece of the puzzle right here, so pay attention. The HELOC accrues interest on an average daily balance. So instead of pushing down the principal of your mortgage once a month as we did before, we are pushing down the principal every single day, thus paying less in interest over that month-long period. Let's try and understand this a bit more with a visual example. John has paid the $10,000 on the first and sweeps these funds over to the HELOC, bringing down the balance to $390,000. Then on the 15th, let's say John has a credit card bill due for $1,000 and an additional $1,000 car payment. John's checking account would be charged and subsequently draw from the HELOC to pay for these bills, bringing up his principal balance to $392,000. Then the rest of John's bills are due on the 25th, totaling $5,000. From then on until John is paid on the 1st, his principal balance on the HELOC would be $395,000. Continuing on to month 2, John's $10,000 direct deposit would hit on the 1st of the month again and drop his HELOC balance to $385,000. Bills would hit throughout the month, and after his $5,000 in expenses, the new balance would be $390,000. Rinse and repeat this method until the home is paid off. In truth, the first year of this loan, you will end up paying more in interest, simply because the interest rate is higher. After this period though, things really start to speed up exponentially, not only for the interest paid each month, but the additional $5,000 a month that you're pushing down the principal of the loan accelerates this process. A common question we get at this point is, what if I don't want to throw an extra $5,000 a month to the principal of my loan? What if I have an emergency expense that I need to pay for later on? Or what if I just simply want to put this into savings? A very valid concern. But if you remember, the nature of a HELOC is that it is accessible and revolving. You can make draws from the available equity you have in your HELOC at any time. It's not like a regular mortgage where once you throw money at principal, it's gone. If that's the case, your only option would be to do a cash out refinance and possibly start your 30-year mortgage all over again. Moving on to the third and final leg of the stool, the IUL life insurance policy. An indexed universal life policy, or IUL, is used to build wealth. Income flows into the sweep account and partly funds this IUL. The IUL returns are based on the performance of the S&P 500 with a 0% floor that guarantees against market losses and a variable upside cap on the gains, providing not only a death benefit, but also chronic and critical illness coverage. This gives you a conservative wealth building tool that addresses multiple life scenarios. The IUL is a powerful financial vehicle. In our example, based on the average of 5 to 7 years, we pay off your mortgage-free loan and all other debts. Essentially, the household is debt-free at this time. Next, we continue to build up the IUL. This would take what would otherwise be paid towards your mortgage interest and payments for 23 years and put this money toward building a tax-advantaged retirement income. The IUL has another benefit as well, allowing you to take loans against your policy without reducing the account value. It allows you to build your wealth with uninterrupted compounding interest. For example, if you have $100,000 in cash value and take out a $50,000 loan, you still earn interest on the full $100,000, and you aren't taxed on the $50,000 loan. The mortgage-free life strategy combines efficient debt reduction with strategic wealth building. This approach transforms your mortgage payments into a tax-advantaged retirement income stream. It's time to become mortgage-free, become your own bank, and help others. So there you have it, the mortgage-free life strategy in action. By leveraging a home equity line of credit, a sweep account, and an indexed universal life policy, or IUL, you're not just paying off your home in record time, you're setting yourself up for long-term financial freedom and a retirement income. This strategy is not for everyone, but for the right person, it can be life-changing. If you meet the qualifications and are ready to take control of your financial future, click the link below and schedule some time with us so we can see if this is the right fit for you.